Welcome to Dividend and Conquer, the go-to channel for savvy investors like you who aim to maximize dividends and master the art of investing. Today, we're diving into a crucial aspect that can significantly impact your investment returns: navigating the complexities of capital gains taxes. Stick around because the insights we're sharing could potentially save you a hefty sum. But before we plunge into the sea of tax strategies, let's take a moment to appreciate the lighter side of finance. Yes, you heard that right. Finance can have its moments of humor. Think of capital gains taxes like your gym routine. Intimidating at first, but once you know the right exercises, you'll be flexing those financial muscles in no time. So get ready to turn those taxing frowns upside down as we delve into the world of smart investing with a smile. Don't forget to hit that subscribe button and ring the bell for the latest updates. Give us a thumbs up if you're ready to tackle taxes with a grin. And let's jump into the main content where we decode the secret language of tax-efficient investing. Capital gains taxes. They might sound intimidating, but they are a crucial aspect of smart investing. To put it simply, these are the taxes you pay on the profit you make from selling an investment. For example, if you bought a stock at $100 and sold it later for $150, the $1.50 you gained is subject to capital gains tax. It's not just about picking the right stocks, it's about strategically managing when and how you sell them to keep more of your earnings. A key strategy involves understanding and applying tax rules to minimize liabilities. This could involve timing the sale of assets to benefit from lower long-term capital gains rates, or offsetting profitable sales with those that incur losses, thereby reducing the overall tax burden. Today, we'll delve into these strategies, highlighting how adept management of capital gains taxes is as crucial as picking the right investments for your financial growth. Imagine this. With the right approach, you could save thousands, maybe even tens of thousands in taxes. And it doesn't matter if your portfolio is modest or worth millions. These strategies are universally applicable. It's like finding a universal remote that controls all your financial devices. Suddenly, everything just works together harmoniously. Imagine telling your friends, "Hey, I just saved a fortune on my taxes," and watching their jaws drop. It's like showing up at a high school reunion in a limousine when everyone else took a cab. And the best part? You don't need to be a Wall Street wizard or a financial guru. These tax-saving tips are like cheat codes in a video game, but completely legal and much more rewarding. You could be sitting on a beach sipping a fancy drink with a little umbrella, all thanks to the money you saved. So let's turn you into a tax-saving superstar, where the only thing you'll be losing is the stress of overpaying Uncle Alex. But before we delve into these tax-saving tips, here's a quick rundown on what capital gains taxes are and why they matter. Simply put, when you sell an investment for more than you paid, the profit you make is your capital gain. And guess who's interested in a share of that profit? Uncle Alex. The amount of tax you pay depends on various factors, including your income level and how long you've held the investment. Now, let's break down the two types of capital gains: short-term and long-term. Short-term gains from investments held for less than a year are taxed as regular income. This means they could be subject to higher tax rates. Long-term gains, on the other hand, benefit from lower tax rates. This is why we often emphasize the value of long-term investing at Dividend and Conquer. It's akin to planting a tree and watching it grow over years, rather than quickly harvesting a plant. But how do you ensure you're not overpaying? First, let's address some common mistakes. One major oversight is not factoring in the distinction between short-term and long-term gains. It's tempting to jump in and out of stocks for quick profits, but remember, the tax implications can significantly eat into those gains. It's like grabbing a slice of cake before dinner. It might satisfy you momentarily, but it costs you more in the long run. Another key area is understanding the implications of investment-related expenses, like margin interest. These can be deducted, reducing your taxable gains. But here's the catch. You need to keep meticulous records. Even a small error on your broker's 1099 form could lead to overpaying taxes. I've seen investors overlook discrepancies, costing them thousands. It's like missing a small leak in a boat. It seems insignificant at first, but can lead to bigger problems if not addressed. Enjoying the insights so far? If you find this content valuable, don't forget to subscribe to Dividend and Conquer for more empowering investment strategies. Your support helps us bring more of this content to you. Now let's pivot to some proactive strategies to minimize your capital gains taxes. One effective approach is tax loss harvesting. This involves selling underperforming stocks to offset gains, thereby reducing your tax liability. It's like turning lemons into lemonade. But for your portfolio, it's a silver lining to investment losses, turning them into an opportunity for tax savings. Think of it as a financial oops eraser, helping you balance out those investment uh-oh moments with some savvy moves. Another strategy, particularly relevant for dividend investors like us, is to maximize the use of retirement accounts like IRAs and 401(k)s. Why? Because dividends and capital gains in these accounts grow tax-deferred, maximizing your compound growth potential. It's like storing your treasure in a magical chest where it quietly multiplies. Imagine the joy of opening it years later to find more than you remembered putting in. Charitable donations offer another avenue for tax savings. By donating appreciated stocks, you avoid capital gains taxes on those stocks and can claim a charitable deduction. It's a win-win. You support a cause you care about and reduce your tax bill. You get to be both a philanthropist and a financially savvy individual. It's like being a superhero whose power is to do good while saving money. And wait, there's more. Let's not forget about the power of Treasury and municipal bonds. These investments come with tax advantages that can be especially beneficial for those in higher tax brackets. It's akin to having a VIP pass in the world of investments, offering exclusive benefits that not everyone is aware of. These bonds can be the quiet heroes of your portfolio, working in the background to protect your returns from tax erosion. In essence, these strategies are like pieces of a puzzle. When put together, they form a picture of a well-rounded, tax-efficient investment strategy. It's about being proactive, not just in choosing your investments, but also in how you manage them. With these tactics, you're not just investing, you're investing wisely. And in the world of dividends and conquering the market, that makes all the difference. Now, let's explore a lesser-known yet highly effective strategy, investing in tax-efficient funds. These are special types of funds crafted to minimize the taxes you pay on investment gains, essentially helping you keep more of what you earn. Intrigued? Let's dive deeper. Picture tax-efficient funds like a clever tool in your investment toolkit, not unlike finding a multi-use gadget hidden in your garage that turns out to be incredibly useful. They're not always the first investment option you might think of, but once you understand their value, you'll see how they can work wonders in your portfolio. It's akin to discovering an all-in-one tool that can tighten, loosen, measure, and even open bottles. Unexpectedly versatile and practical. In the same way, tax-efficient funds can serve multiple purposes in your financial plan. They help in strategically positioning your investments to grow, while reducing the bite that taxes can take out of your returns. Today we've journeyed through the labyrinth of capital gains taxes and unearthed strategies to keep more of your investment earnings. Remember, it's not just about how much you make, but how much you keep. Before we wrap up, I have a question for you. Which of these tax-saving strategies do you plan to implement in your investment journey? Share your thoughts in the comments below. Remember, we are not financial advisors, and the content presented in this video is for informational and educational purposes only. Always consult with a licensed financial professional before making any investment decisions. And there you have it, folks. Strategies to conquer capital gains taxes and maximize your dividends. If you found this video helpful, please hit the like button and subscribe to Dividend and Conquer for more insightful investment content. Stay smart, stay invested, and let's conquer the financial world together.